This is Robert Kraft, and I'm your host on the Planet MicroCap podcast. And with me today, a very special guest, new to the program, Mr. Garvin Jabusch. He is the co-founder and CIO of Green Alpha Advisors based in Boulder, Colorado. Garvin, great to meet you. Thank you for joining me.
Hey, Robert. Thanks for having me on. It's a real pleasure.
It's a pleasure to have you. So as we do with all my guests on the program, let's start with your background. How'd you get your start and then develop to where you're at today at Green Alpha Advisors?
Sure. In this industry, I guess you'd have to say, going back to my MBA, I went to the Thunderbird School of Global Management at ASU, and I got my MBA there, and shortly thereafter started working at Morgan Stanley. Did a lot of different roles there, probably the most interesting of which was being a global resource for a thing called strategic services. I learned a lot there because what they had us do was roam around the world kind of vetting projects or kicking off projects that the executive management wanted to try. So we helped with an acquisition in Spain and one in the UK and one in Italy, and did some general stuff like that around the world. One of the things I did was help spin off the Morgan Stanley online unit back during the dot-com crash. And so it's a little bit interesting to me that they've subsequently decided to buy E-Trade and get back into that business after they exited it, more than a couple decades back now.
Right.
So that was interesting. Then I got stolen away from Morgan by a thing called Forward Funds in San Francisco. This was the investment services arm of the Getty family office. And I got to go in and work with a lot of really interesting and smart people, including the patriarch Gordon Getty himself, who's a smart guy and understands the industry very well, came to work every day, even though goodness knows he doesn't have to. And there I got my start with sustainability investing. Because why they called me over at Morgan was they had won an RFP to co-brand a mutual fund with the Sierra Club. They were a little bit surprised to win the RFP and get the business, and they looked around and said, uh-oh, we don't have anybody to manage this portfolio.
Right.
So they knew I had this background in earth science and like archaeology, and they thought, here is an equities guy who understands a little bit about sustainability and about the environment. This is in 2001, Robert, so it was early. And they poached me away, and I moved to San Francisco and started running the Sierra Club stock fund. Then subsequently, we later in 2007, we founded Green Alpha Advisors, and in 2008 launched our first strategy. So that's a little background.
Very cool. And we're going to dig right in there. But, before we dig into some of your now current strategy on sustainability and green investing, I have to ask, as a core Indiana Jones fan, and I know most of my audience are probably Indiana Jones fans. I can't remember the last time I talked to a former or current archaeologist. So tell us a little bit about that experience and how that lent itself to then investing.
Well, it was a great experience. It was a lot of fun. I did archaeology and physical anthropology. That's the branch of anthropology that's more the stones and bones, as opposed to the cultural anthropology, which is more the histories and stories and legends. And I was at the University of Utah. I graduated from there with a bachelor's in anthro, and then went into a PhD program in physical anthro, which involved a lot of archaeology. I'm a huge fan of Indiana Jones too. And I think most of the people still working in that industry would say, we wish it was a little more like that. It's actually very procedural and careful and scientific, and it's an awful lot of digging and then drawing and photographing and then digging some more, and then there's a lot of walking around looking for stuff. And it's actually a great life. I loved it. I did that right up until I decided to go do my graduate work in finance. I left before finishing my PhD. I'm one of those guys that quit on their doctorate before they could quite finish it and went off to do something else. But I loved it. You spend the summers and the dig seasons out on the ground, and just in the desert or wherever it is you're digging, and you have your maybe your dog and your cooler with a few beers in it, and you work hard all day and you just relax under the stars at night, and it's a wonderful life. But for me, and this isn't true of everyone, a lot of the real scholars that dig into it really commit to it and really contribute a lot to our knowledge about previous civilizations and about humanity in general. But for me, it started to feel like Well, this is a little bit like spending my whole life at summer camp, and maybe I should think about doing something else. I guess it wasn't a perfect personality fit for me, even though I loved it. And so I was ready to move on, and in '93 I did, and I left the world of digging holes in the ground and went to business school.
Nice. Well, one last follow up on that. Do you have any? What's your coolest archaeology story? I mean, I know you got one.
Um, that's a really good question, and it's tough because there's a handful of fun ones. Um, you know, I worked a couple of seasons in Jordan at the town of Petra, and since I bring this one up because the site of
Last
Petra,
Crusade.
Last Crusade. You
Let's
said you're an
go.
Indiana Jones fan, so I got to mention that one. We spent 2 seasons working in a place called the Temple of the Winged Lions.
Cool.
And what we were doing was looking for a written archive of the Nabatean Empire, which no one had yet at that time found. And yet they were a trading hub. Talk about investing and the global economics. They were one of the hearts of that in their day. And they were one of the key nodes on the Silk Road from China back through to the Middle East and then on up into Europe, right around, from the time of a couple hundred BC to a couple hundred AD. Including having their own empire and then being occupied by Rome and then eventually succumbing to a big earthquake and the changing trade routes. And we knew they must have very detailed trade records and tax records and all that stuff that literate civilizations come to have, especially the big ones that get wealthy, which Petra really was. You can just tell by those buildings in that movie. They were not a poor civilization. And we didn't uncover the archives. We thought a temple would be a good place to look. But meanwhile, we did find a lot of really interesting stuff. Probably the coolest thing I personally found was somebody's coin stash. It was in a jar, like a pottery jar about this big, and it was buried under a bunch of rubble. So it had gotten buried by an earthquake, I reckon, and it had just been forgotten and lost by somebody, and it was jammed with Nabatean and Roman coins.
Wow.
I think it's some dudes or some kid's coin stash, and I just happened to find it. It was cool stuff. I understand that it is on display at the Jordan Museum.
Wow. That's
So that was fun.
that sounds so cool. It's funny actually. My wife and I, we were just in Israel over the summer, and we wanted to go to Petra so bad, but Israel in August. I think and my wife was pregnant at the time, so everybody was like, do not go." And I was like, "Oh, bummer." And we were planning on doing it, it just didn't happen.
Well, it would have been 110 degrees, and there's a lot of cool stuff to do there, but most of it involves hiking. So I don't know about being pregnant and doing that.
Yeah, that's what everybody was saying. Like, dude, you're literally walking the entire time, and you sweat like a camel. But camels don't. You need enough water like a camel. Anyways, we digress. But
In a good way, though.
oh yeah, that was awesome. But all right, so now I want to get to your investing strategy, and real quick, I want to preface our audience. We're actually doing this interview on March 12th, 2020. It's one of those record crazy days that we've seen of late, and so this interview is probably going to be coming out a little bit after today. So we'll probably be discussing some themes around today because I mean, where are we at? Down, closed 9.9% down on the Dow. Anyways. But let's get into your investing philosophy and strategy at Green Alpha.
Sure. It's kind of a nice dovetail from the background of the archaeology and the thinking about ancient civilizations, because I think that it's interesting to bring an interdisciplinary approach to investing. So many folks are pretty narrowly focused just on what you learn when you do an MBA, and that's do the discounted cash flow and do the valuation analysis. And these things are all very important, don't get me wrong, but I think you get an extra dimension by bringing a little bit more macro in and a little bit more long-term thinking in, particularly if you're a buy and hold, long-term, long-only strategy like we are. If you are doing high-frequency trading or any kind of flash-type strategies, that doesn't matter. But for the long-term investor, it does. And my colleagues and I, we've learned a lot about what makes civilizations thrive and what makes them suffer and struggle. And I think that bringing that approach and bringing a kind of a scientific perspective to the whole endeavor is what makes this different. And so I say that by way of getting to directly answering your question. which is to say that we think there's twin tailwinds, and I can give a lot more color around this if you like. But we think there's two big tailwinds that are going to drive valuations and returns over the long run. Crazy down days like today, notwithstanding, except for opportunities for entry points. And those two things are one, innovation. You have to own innovation. This has been the primary driver of economic growth for almost the entire history of civilization since somebody chiseled out a wheel. And we think it's very important to make sure you own the firms that own the IP around the innovation. The value almost always rolls up to the owner of the intellectual property. This is critical. You need to own that because this is where forward growth comes from. And then secondly, today, we're in a little bit of a different time in that the system level risks that confront the global economy are different and more pressing than they've ever been at any time in the history of civilization. And so these system level risks, and this is a little bit where the divergence from traditional portfolio management comes in. These system level risks, of course, are the climate crisis. They are resource degradation, so things like topsoil and water degradation, the air, whatever resource you care to mention, really, and then worsening inequality. These are all system level risks that present fundamental threats to the global economy, and they're a big deal. So we think that making sure to not own the causes or the main causes of those risks is paramount, because taking a long-term view, by definition, anything that presents a threat to the economy, a long-term threat to undermine the economy, by definition makes a crappy long-term investment. You can't hold that indefinitely because it will cause the economy to collapse. This is why we've never owned fossil fuels, for example. Not so much because we signed up for the divest invest movement in some ESG way, but because we could see that they can't persist indefinitely as the way to power civilization, and therefore that their growth phase is likely to not last very much longer, if any longer at this point. Now, will fossil fuels be around for a long time? Sure, of course. There's still so many gas-burning cars out there and other uses for them. It's just that we believe their growth phase is over, and certainly their rapid growth phase is over. As you know very well, Robert, stock prices are based on growth expectations. You can forget about that for fossil fuels from now on. And while we've been fossil-free since we launched our firm, now it's more obvious than ever that was the appropriate long-term call. It avoids downside risk, and as we transition to a more sustainable economy and try to get away from the system level risk that fossils provide. And then it also means your capital isn't tied up over there, and so you're more free to invest in the big innovators that are providing not only solutions to our system level risks, but also that are just innovating in a way that makes the economy more productive and efficient, and therefore creates value and therefore wealth. Right. So that's really the superstructure of our strategy.
Gotcha. All right. So as you said, you built your fund and strategy based on the two tailwinds being innovation, and I think you said sustainability is the second one, but I'm just assuming that it's sustainability as well.
Sustainability is good shorthand for it. I really think of it as steering out of the path of system level risk.
I see. Okay. Yeah. All right. So out of the path of system level risk, and so then I can already hear my audience asking me. We'll ask him. What's your criteria to really be able to suss out which companies fit your strategy and you'd like to add to your portfolio?
So this is really the key question in the world of sustainability-oriented investing right now. And there's 100 different ways to do it. There's the most common approach that equity managers are taking right now is to apply ESG scores.
Right.
And there's any number of vendors.
Real quick, for those who may not know, what is an ESG score?
ESG refers to environmental, social, and governance, and that's just the acronym. And normally, ESG criteria. Now, here's one of the tricks, though, or one of the issues, that there are different criteria for ESG depending on what organization you're talking to. Like MSCI has their own ESG criteria. There's one of the big vendors is called Sustainalytics. They've got their own ideas. Morningstar has their own ideas. There's any number of different ways to slice up ESG criteria, and some focus more on the E. We certainly do, environmental. Others more on the S, social, and others more on the G, governance. I also happen to think the governance is very important because that comes back around to things like fundamental value, like is a corporation a good steward of capital? That's a governance issue, and it's also a fundamental value issue. So E and G, I think, are the most important, although S is certainly important too, and we can talk about that because things like having a more diverse leadership team mean the organization probably, science shows us, probably has greater cognitive capacity and therefore is more likely to make better long-term decisions. So E and S and G are all important, but we focus very much on the E because that's where most of the system level risks are coming from and where we see an awful lot of the innovation coming from in order to address those risks, or at least find a different way to run the economy that doesn't create so many risks. So ESG.
ESG, perfect. Okay, now we can get back to the original question. So how do you use ESG score and some of your other criteria to find investments for your portfolio?
Okay, so having said all that and telling you how much I value ESG, I will tell you we don't use ESG scores. We don't buy them from Morningstar or MSCI or anybody else, and there is a simple reason for that, because we think that very often organizations are prioritizing the ESG criteria in the wrong order, and I can illustrate that with a couple of examples. But we think that Jeremy, GMO out of Boston. A big, like, whatever, $110 billion manager, maybe more like 100 after today. But they have one of their senior guys, one of the founders and portfolio managers, Jeremy Grantham, said something interesting a couple weeks ago. He said, E is about survival, S and G are about behavior, so we know where to focus our attention. We agree with that. He put it very concisely. I wish I'd said that. And so when we look at a company and our highest level heuristic about whether or not we can start to consider it for one of our strategies is not to look at its ESG scores, but rather to look at where it's earning its revenue. And what's key there is to see, is this firm getting paid to lower the overall risk profile to the global economy, or is it getting paid to increase risks to us all?
I see.
For me, this is crucial, and it has to come before you start thinking about ESG criteria, because it doesn't matter to me in terms of long-term viability if a company does have wonderful things like great benefits or good diversity policies or whatever you might find on the ESG criteria that make it look very high-ranking, when in fact it is doing a lot to undermine the global economy in the long run by presenting system level risk. So for example, you can find sustainability portfolios that are full of things like Anadarko and TransCanada and companies that are visibly creating more risk for the global economy in the long run, and yet they can find their way into ESG branded or even sustainability branded portfolios because they have good ESG scores. We think this is the wrong approach.
I see.
You have to start by figuring out if the company is raising or lowering the overall risk to the global economy, and then you can think about your ESG scores.
All right. So then from there, look, we're primarily a small micro nano cap podcast, and I know just from experience in doing all these interviews over the years with lots of value-based investors and even growth and GARP investors, a lot of the times there's a risk premium some investors will take depending on where that company is situated in terms of sector and some of the products that they're putting out there. But for it sounds like with your strategy, you have to really have a good idea of what that risk premium is, because you might be dealing, and this is just projection, I don't know for a fact, but you might be dealing with companies that may not be profitable or even revenue generating yet, especially if they're developing technologies for the future. I mean, so how for you and your strategy, are you looking mostly for revenue generating companies just to start there, or if it's a revolutionary technology, maybe still pre-revenue, do you tend to also look at those as well?
Both and. Okay. Mostly we want to focus on companies that do have revenue, and ideally not only revenue but also earnings and free cash flow. That said, where there's a fantastic opportunity that might still be probably not pre-rev, but pre-earnings anyway, because they're still in growth phase and plowing so much back into the business, we will certainly look at those. And, our overall approach, once we've decided, so we call our thesis next economics, because we talk about the next economy and we talk about how we model what it can look like, how a low risk economy will look. And we try to invest in the companies that are leading the way to that world, right? That are out in front of that right now, and maybe could even already be a citizen of a very low risk economy going forward. And so that comes down to evaluating where their revenues come from, like we were talking about a moment ago. Okay, once we've determined that a company is a good citizen of the next economy, doing more to lower global risk than to raise it, we then look a little bit more traditional. I then want to, I guess, of the things you mentioned, we're closest to being HERP. We call that huge upside at a reasonable price, GARP.
I think you might want to change that
one. And so we have an approach that I've kind of taken to calling modified Graham-Dodd, meaning we do want to look for good value relative to the growth prospects. Why that word modified has to be on there is because, old Ben Graham, one of his key rules was thou shalt not do macro. Just look at the valuation, look at what you're getting for what you have to pay, the end. Okay, that does work, and that is a valuable approach, especially in his day. In the 30s, that was kind of what you had to work with. We don't live in that world anymore. It's a time of exponential change, both in terms of innovation and just economic change, and in terms of the big risks confronting us. These things are both larger and faster moving than they were in his time. And not only that, but their rate of acceleration is faster. And so if you're not doing macro, in addition to trying to figure out the fundamentals of any company you're considering investing in, you're not thinking through the company in what I would consider to be an appropriate way. If you're not layering the macro environment over the company's prospects, what chance do you have of having an accurate discounted cash flow? Like just to give a low-hanging fruit example, think about something like the world's leading, and again, it comes back to the ownership of the intellectual property, the world's leading IP owner for the most advanced wind turbines. Okay, well, they have a certain cost of goods sold. They have a certain margin. They can work on improving those things and widening their margins, of course, like any other business. But then let's compare that to the other generators of electricity, like the easiest one would be like coal-fired turbines and boilers. Well, okay, we know based on IEA speculation and other forecasts that wind energy is going to grow, between 20 and 25% a year, every year for the next 2 decades. This is a macro picture. This is thinking through system level risks. This is judging what's going to happen to that market. We know that coal is in decline. So just because, Ben Graham would have said, oh my God, you can have that coal company. I mean, I don't know that he would have said that, but his analysis might lead one to say something like, wow, you can have this coal company for 5 times earnings right now, but this wind company, you got to pay 22 times earnings. I know which one I think is value, right? Well, I would flat disagree with that. You have to consider the macro picture. You have to look at which one's more innovative. You have to look at which one's looking forward and which one's looking backward, and you have to consider what's likely to unfold over the next couple decades. Again, long-term strategies.
Gotcha.
So this is why we think about modified Graham-Dodd. Yes, we want value, but we want good value relative to growth prospects, and that might not always mean a good PE.
Right. I mean, so then it really comes down to, even because let's say you don't have good PE stock, or maybe that company's still not profitable yet, management comes into play more so than a little bit, I'd say. I mean, again, small micro nano cap podcast. I mean, I think I ask everybody on here about management. In your case, I feel like it's even more crucial. So, I mean, how do you guys assess management so that you can tell that they're also in it for the long term and they have the strategy in place for the company to get to those prospects that you potentially foresee?
Comes right back to governance and why it's so important. I think every investor, whether or not you care at all about ESG, you should be really uptight about evaluating governance. And for me, the key things to look at there There's several fold. One, you want to look at how the board compensates them. I get a little bit nervous when the board compensates them too much on per share metrics. I don't really care that much about earnings per share because that's easy to manipulate, and you can manipulate it in ways that are bad for the company, like by doing too much in the way of share buybacks. If you're so compensated for having a good EPS that you do things that are a little bit crazy, like go into debt in order to buy enough shares back to make that look good, that's terrible. That's a little bit like a farmer eating the seed corn. When you should be plowing a lot of that back into your R&D and generating new IP and hiring the top talent. These are the things that I want to look for in terms of really liking the management. Secondly, I want a big commitment to innovation. I just mentioned R&D. The more they, and it varies by industry, of course. Not every industry is as innovation forward as every other. But I want to see them putting a significant amount of those revenues right back into R&D. I want their intellectual property portfolio to be growing. And not just kind of coasting on their laurels from the last cool thing that they did, because this is where growth comes from. Again, now you have to be a little more patient with a company like that, but that's okay because it will pay off for the long-term investor. For an example here, I don't necessarily need to discuss any individual companies unless you ask, but I think about the owners of the gene editing technology CRISPR-Cas9. These companies are very early. They are not pre-rev, but they're pretty low rev still because they don't have any therapies in the clinic yet. And yet this is transformative technology. And basically 3 companies own most of the intellectual property around it so far. You have to own the basket. You need to own all 3. And we're talking about humanity having now taken direct control of evolution. After 3.5 billion years of evolution going on, we can now control it directly by editing genes. This is inestimably huge. And just because they don't have therapies in the clinic yet does not mean there isn't enormous upside potential for them. Now, is there risk? Could some of their trials fail or even cause problems? Yeah. And I think that's why their valuations are still pretty low. The 3 owners of most of the IP together are still valued at less than $5 billion. Right. And yet I think that in a decade, it could be some enormous multiple of that number. And yet the street hasn't really bought it yet, which is why they're still so cheap.
Well,
this is what I mean by owning IP. I was just going to tie a bow on that.
Yeah.
By saying, this is what I mean by making sure you own the critical IP that's helping to define the future, even if the PE isn't there for it yet. Because in the case of these companies, it certainly isn't. There just isn't that much rev yet.
Right. Well, at the end of the day, what it seems like is core to your strategy is your philosophy on time horizon. So I'd love to learn a little bit more on that. What do you think about time horizon in terms of your investing strategy?
Yeah, we're certainly very long term. We think that and a lot of our clients concentrate around 401ks, retirement plans, and then endowments and other organizations like family offices that have very long term, if not perpetual horizons. And we do think that's appropriate. You might do very well with our strategies over a year or two. 2019, we did exceptionally well. We earned a lot of alpha over every major benchmark. So far this year, we're down, as you might imagine, but we've shown decent downside capture versus the big benchmarks. Down about 2/3 as much as them so far this year. You might do okay on the short term, but you might not. One of the things about our strategies, Robert, is that we don't try to correlate. We think about risk as big risks that can really deflate, if not outright undermine the economy. And we work to manage those risks. We think we are managing the risks that matter most. A lot of investment management is focused on thinking about risk as tracking error with the benchmark. We disagree with that. We think that volatility and tracking error are not the same thing as risk, and therefore we don't attempt to correlate with any bench. And this is why you really need to think about our strategies as long-term, because since we don't manage to correlate or to have low tracking error, we don't. we don't. If you put a historical price chart of our mutual fund against any big benchmark, you will notice general equities correlation, sure, but you won't notice that much correlation. Because in looking for the smartest companies with the best governance and the most careful stewards of capital that also own the best intellectual and most intellectual property for what's next, again, as opposed to looking backwards at what was, you need to be a go anywhere strategy. And so we're all cap, cross sector, cross industry, and global.
Got it.
Which means we're not going to correlate with any given bench that much. Our stated bench is the MSCI ACWI IMI, the Investable Market Index, because we do view that as our opportunity set, any stock anywhere. And so that's our stated bench, but even then we don't correlate with it that closely. And so if you're looking for benchmark type returns, you should probably just go ahead and buy your cheap Vanguard fund and take beta, right? But if you're interested in being innovation facing and thinking about a sustainable economy and having a shot at some alpha, especially over the long term, our strategies might look really interesting.
Gotcha. So, I in preparation for our interview today, your team sent over some interesting aspects of your background as well. Not just your archaeology, but I wanted to hit on this point about the politics of sustainability because you were, as it says here, the first asset manager invited to testify before the House Selection Committee on the climate crisis. So I'm just very curious why Congress needed to hear more from you and what that experience was like and what you were really trying to push.
That was an interesting day. The House Select Committee on the Climate Crisis is chaired by Representative Kathy Castor. She represents one of the districts in Florida near Tampa. And, she's not my rep. I hadn't known about her before or met her, but I was very impressed by her and her committee. She's very committed to the idea of sustainability and confronting the climate crisis. And she wanted to hear from all kinds of industries around this country about what the risks to their industry may be, but also what risks their industry might be presenting to exacerbate the climate crisis may be. So I testified on both of those topics, and I said the risk to our industry is that the economy could really be undermined by the climate crisis, and you could see asset prices deflate. You could see the economy itself run into some struggles. More interesting, I think, and less expected by her and the other members of the committee was the risk I mentioned coming from the investment management industry. Given our conversation to this point, you're not going to be surprised to hear me say, I said the biggest problem coming from the investment management industry regarding the climate crisis is that, for the most part, our industry is flat ignoring it. This, catches everyone a little bit by surprise, but it's true. You probably are aware, 85% of every dollar going into equities today just flows straight into an index fund. Well, I view this as a fundamental problem because the large indices, especially the S&P 500 funds, the Dow 30 funds, any of the major benchmarks, these are full of the causes of systemic risk, full of them. The S&P 500 has 60 fossil fuels companies in it. I tell people, if you buy the S&P 500, you might believe you're investing passively, but you're not. You're making an active bet on potential collapse. You're hoping to profit from the climate crisis. This is a problem. And then on a higher level, I think this is dangerous for investment management. I'm sure you've heard this argument before, because what it's doing is short-circuiting the invisible hand. Of course, what investments are supposed to do is chase the next best idea and the greatest new advance in productivity and just economic expansion, right? But as long as everybody's just blindly indexing, that doesn't happen anymore. Stocks aren't being bought because of their relative valuation or how good their idea is or even what the company does anymore. 80% of all stocks are being bought because they sit in an index somewhere. This is a complete short circuit of the efficient market. It is a reversal of the invisible hand, and it's, in my opinion, very dangerous over the long term. And I told the committee that there is cognitive dissonance between how we all invest and what we're all doing to respond to the climate crisis. Even a lot of people who would consider themselves very concerned about the climate crisis just simply have the S&P 500 in their 401k, for example, just because that's the conventional wisdom. That's what you do. You just buy the index. We are all told that you'll never beat it and you'll never find a lower fee. That latter part may be true, but the former part certainly isn't. And the other, and then you're also going to get caught with a bunch of the causes of our big high level risks. It's not, you know, the governor of the Bank of England, Mark Carney, is one of the big voices on this that agrees with me. And or maybe you should say I agree with him. I don't know, but he's saying there's going to be a dramatic repricing at some point for the carbon exposed economy when markets have a general realization of how dangerous it really is and how much risk it really does present. He talks about a Minsky moment, right? A dramatic downward repricing of any asset class. He thinks there's a Minsky moment coming for the carbon economy and not the one we just had Monday because of OPEC opening up the spigot, but rather one that comes with a realization that we're not going to be dependent on fossil fuels forever and that they do cause too much risk. Well, if you own SPX, when that Minsky moment comes, you're caught with your pants down. And it's not that great from an investment management point of view. It's not that good from an efficient markets point of view. And it certainly isn't good in terms of investments doing what they're supposed to be doing, which is chasing the next best new idea and not the same old busted idea about, I don't know, fossil fuels or internal combustion engines.
Okay, you went in, you testified, you said everything that you more or less said on here.
Yeah.
Probably condensed a lot more. But
Yeah, they only give you so many minutes. Unlike you, they're not generous with time.
well, let me ask you this. So let's say you were on that committee. What should they do based on all this information that you presented to them?
You know, they asked me that.
What can they do?
Subsequently though, at a reception, a couple of them asked me like, well, what might be an interesting policy proposal? And I had some things that I know they can't do, but that I think might help break the cognitive dissonance. I said, well, you're going to tell me this is not possible in the current environment, but what if you did something like treat it like cigarettes? What if when you log into your online brokerage account and you go to buy an SPX fund, what if there was a pop-up? Yeah, I think everybody should be able to buy what they want. And everybody needs to, I don't think they should prohibit anything. But what if you just made sure people were informed? So I said, what if you go to buy an S&P 500 fund and just before you could actually click the buy button, there was a little pop-up in between that said, hey, warning, the portfolio you're about to buy contains companies that are incompatible with a livable climate. What if you just did that? That would help break the cognitive dissonance. And of course, they all shook their heads and said, oh my God, I could never get anything like that through. But that's okay. I just wanted to put that in their heads that there are policy things you could think about doing. And we need to do something to help people understand that the way they invest really does impact what goes on in the economy, because clearly where investment flows go is where the economy happens. And as long as 80% of all investments are going to the legacy economy that got us into all this trouble, that's the economy we're going to continue to get. And so it's important to break that cognitive dissonance. And I think that it's as important in investment management as it is anywhere else in the economy, with the possible exceptions of energy and transportation. But see, where capital flows in energy and transportation determines the trajectory of those industries. And so investment management might be the most important overall industry in terms of combating the climate crisis. And the first step there is for people to be informed about what they're investing in and what impact that's having. And so like something like a funny pop-up that goes, hey, just be aware what you're about to buy now. That'd be a good start.
Well, I mean, I'd love to at least see the proposal and at least it be debated. Start here. They say no. Okay, we can meet somewhere.
Yeah, let's have a debate. That's all. That's all I'm asking.
Oh yeah. All right. So here's my favorite question to ask everybody who I have come on here. What investing experience would you say impacted your career the most?
Early in my career, we were going through the dot-com bubble. And I was young enough and naive enough that, like a lot of managers at that time, you felt like a genius just because everything was going up and you couldn't buy anything that wasn't going up. And you just thought, this is easy. That old Michael Lewis thing, they felt like the masters of the universe. It's true, you kind of did. And so I learned an awful lot from the dot-com collapse of 2000, March of 2000. I remember it very well. I I had friends who saw it coming. There was one guy I worked with who was short Amazon, and of course that went on to rally and become one of the globe's leading companies. But he was short Amazon on the basis that back when they were only selling books, they were trading at some stupid 400 multiple, and he calculated that they were going to have to sell every book ever sold for 40 years to justify that multiple. And so he was short, and he just got his hat handed to him because, like Buffett said, you can stay short a lot longer than the market can stay. The market can stay irrational a lot longer than you can stay short. It was true. And so I was definitely on the long side of all of those, and he was right. He was just early. And man, that experience taught me a lot about forget everything you think you know and think about every company intrinsically. That is where I learned, and we practice this at Green Alpha to this day. Forget everything you know about what's in the index or what the trend is or what the conventional wisdom is, and think about every company you're going to buy like you're a venture capitalist or like you're a private equity investor, and actually dig into it and judge it and evaluate it on its merits, period. And not just because it's in an index or not just because it has a decent ESG score. That's not going to work. You need to think everything through like it's not a public stock, and like you need to really be able to dig in and understand that business. And if you do that, I think you've got a much better chance at avoiding long-term risk. And I think you've got a much better chance of finding good long-term growth prospects for decent prices.
Well, with that, you've given some great advice already, but for let's say as it exists right now today, because I have a distinct feeling that today is not going to, March 12th, 2020 is not going to be the end of this. We're probably going to see some more down days. So, what's your advice for someone who's been through some of these, boom and bust recession cycles? What should new investors look for to either maintain the chill or to potentially profit from situations like this?
So you're right in that this probably isn't the bottom, and yet calling a bottom is pretty much impossible. There'll be some people that do it. That's probably chance, which is cool. I'm happy for them. I think that looking for the greatest beneficiaries of the reinflation when that happens. I know a lot of people think this is going to be V-shaped, and as soon as we get past the worst of coronavirus, we're going to have a rally that could very well be. It could be more U-shaped in that it takes a lot longer than people think. I don't really believe in the L-shaped narrative that it's just going to go down and stay down indefinitely. I don't think the economy works like that. I think that there's always growth. I think there's always innovation. I think people are people and we're expansionist by nature. I think that we are going to see a recovery. I just don't know when. Okay, so first of all, if you're buying now, you need to be thinking long-term because there could be more downside pain to come. Maybe not that much, but maybe quite a bit more. In 2008, we fell in half. We're not there yet, but we could be. We could go that far, right? In 2000, we fell in half. Like, these events happen. We have 50% bear markets sometimes. Okay, so who are the biggest beneficiaries when there's a return to growth? One, governance again. The companies that have been the smartest stewards of capital. During the good times, if you were spending all your free cash flow and then maybe on top of that even borrowing to do things like buy your shares back, well, now you're going to get downgraded. Your credit's going to be downgraded. You're going to have a tougher time accessing capital. You're going to have a much tougher time competing with companies that weren't doing that when times were good. So look for the good stewards of capital. So right back to governance. Companies that were doing minimal buybacks and were doing things like reinvesting in top talent and R&D. These are the place, and so therefore they've got better credit ratings, better profiles, cheaper access to capital, more access to capital when times get good again. These are going to be the companies that gain market share and grow faster and provide better returns for their owners. Secondly, like I was saying before, take advantage of pullbacks to buy these owners of the intellectual property that is defining the future. So we talked a little bit about biotech. Check, do that one. Think about the big leaders with the best IP portfolios in energy. Check. In transportation. Check. Do these things. I'm just telling you how I manage my portfolio now. Do these things, and you'll be owning the companies that have the best chance of the most rapid reacceleration when we do reach the bottom. Again, I don't know when that's going to be, but we will. And you want to be positioned to benefit from that when it happens. And Again, without trying to call a date of the bottom, I would also caution folks not to wait too long for that, because most investors miss it because of a reasonable fear that they have that the pullback is going to go on indefinitely. Almost every non-professional and a lot of professional investors end up missing a big chunk of the rally, and that's a real risk.
Yep.
Peter Lynch talked about that best in his book, One Up on Wall Street. That's an old-timey book, but he nailed that.
It was my first book that I read on investing, so I 100% agree.
Yeah.
So Garvin, with that, thank you so much for joining me on this podcast. Where can my audience go and find everything they need to know about you and Green Alpha?
Probably our website's the best place, greenalphaadvisors.com. And we spelled advisors with an O-R-S, not an E-R-S. I just thought that's how you spelled it when we founded the firm. And it turns out, guess what? Both are right. I looked up in the OED and it goes, both are correct. I'm like, oh, sure. So greenalphaadvisors.com. I'm on Twitter at Garvin1313. Believe it or not, there's so many Garvins, I had to resort to 2 13s. I was like, really? And then, of course, we're on LinkedIn, both as a firm and as individuals. And you can also, on our website, sign up to get our periodic newsletters. We had one come out Tuesday about the pullback to tell people what we're thinking about that. And then also, I read a monthly column for Worth magazine, and you can see that on worth.com.
Perfect. Well, with that, Garvin, thank you again for joining me. This was an absolute pleasure, and I look forward to chatting again soon.
Hey, Robert, it was tons of fun. I appreciate you having me on.
Thank you.
All right.